the ultimate destination for smart investing. Welcome to Invest Ideas, where we turn your financial dreams into reality. Subscribe now and join us on the path to financial freedom. Debt is often seen as a dirty word, something to be avoided at all costs. However, for the wealthy, debt can be a powerful tool for creating wealth and growing their fortunes. In fact, many of the richest people in the world use debt to their advantage, using it as a lever to increase their wealth and create even greater opportunities for themselves. Here are 21 ways that rich people make money with debt. 1. Real estate investment trusts, REITs. Real estate investment trusts, or REITs, are a popular way for wealthy individuals to invest in real estate without actually owning property. Essentially, REITs are companies that own and manage a portfolio of real estate properties, such as apartment buildings, shopping malls, and office buildings. Investors can purchase shares in these companies, which allows them to earn a share of the profits generated by the properties owned by the REIT. Many REITs use debt to finance the purchase of new properties, which allows them to grow their portfolio and generate even greater profits. As a result, investing in REITs can be a smart way for wealthy individuals to use debt to generate income. 1. Leveraged buyouts. Leveraged buyouts, or LBOs, are a way for wealthy individuals to purchase a company using borrowed money. Essentially, the buyer borrows a large amount of money to finance the purchase of the company, with the goal of using the profits generated by the company to pay off the debt and make a profit. LBOs can be risky, as the buyer is taking on a large amount of debt in order to purchase the company. However, they can also be extremely profitable, as the profits generated by the company can be used to pay off the debt and generate even greater returns. 1. Real estate flipping. Real estate flipping is a popular way for wealthy individuals to use debt to generate income. Essentially, the investor purchases a property with the goal of fixing it up and selling it for a profit. The investor typically uses a combination of their own money and borrowed money to finance the purchase and renovation of the property. While real estate flipping can be risky, it can also be extremely profitable. With the right property and a good renovation plan, investors can generate significant returns on their investment. 1. Private equity. Private equity is a way for wealthy individuals to invest in companies that are not publicly traded. Essentially, the investor purchases a stake in the company with the goal of generating a return on their investment. Many private equity firms use debt to finance the purchase of companies, which allows them to generate greater returns on their investment. While private equity investments can be risky, they can also be extremely lucrative for those who know what they are doing. Hedge funds are investment funds that use a variety of investment strategies, including the use of leverage and derivatives, to generate returns for their investors. Hedge funds are typically only available to accredited investors, as they can be risky and complex. By using debt to finance their investments, hedge funds can increase their investment capacity and potentially generate even greater returns. However, these investments can be risky, and investors should do their due diligence before investing. Short selling is a strategy in which an investor borrows shares of a stock and sells them, with the expectation that the price of the stock will decrease. The investor can then buy back the shares at a lower price and return them to the lender, generating a profit. By using debt to finance their short selling strategy, investors can increase their investment capacity and potentially generate even greater returns. However, short selling can be risky, as the price of the stock can increase, resulting in a loss for the investor. Forex, or foreign exchange, trading is the buying and selling of currencies in the global marketplace. Investors can use leverage to increase their investment capacity and potentially generate significant returns. By using debt to finance their forex trading, investors can increase their investment capacity and potentially generate even greater returns. However, forex trading can be complex and risky, and investors should do their due diligence before investing. Additionally, the use of leverage can increase the potential for losses. Mortgage investing is a way for individuals to invest in mortgages, either by buying a mortgage or investing in a pool of mortgages. Essentially, the investor earns a return based on the interest paid by the borrower on the mortgage. By using debt to finance their mortgage investments, investors can generate significant returns on their investment. However, these investments can be risky, as the borrower may default on the mortgage, resulting in a loss for the investor. Margin investing is a way for investors to borrow money to buy securities, using the securities as collateral for the loan. Essentially, the investor borrows money from a broker to purchase securities, with the expectation that the value of the securities will increase, generating a profit for the investor. By using debt to finance their margin investments, investors can increase their investment capacity and potentially generate greater returns. However, margin investing can be risky, as the value of the securities may decrease, resulting in a loss for the investor. Refinancing is a way for individuals or businesses to replace their existing debt with a new debt, typically with a lower interest rate or more favorable terms. Essentially, the borrower takes out a new loan to pay off the existing loan. By using debt to refinance their existing debt, borrowers can potentially lower their monthly payments and save money on interest. However, refinancing can be risky, as the borrower may not qualify for a lower interest rate or more favorable terms, resulting in no savings or even higher costs. 1. Hedge funds. Hedge funds are a way for wealthy individuals to invest in a diversified portfolio of assets. Hedge fund managers typically use a combination of strategies, including leverage, to generate returns for their investors. By using debt to finance their investments, hedge fund managers can generate even greater returns for their investors. However, hedge fund investments can be risky, and investors should do their due diligence before investing. 1. Margin trading. Margin trading is a way for wealthy individuals to purchase stocks using borrowed money. Essentially, the investor borrows money from a broker to purchase stocks, with the goal of generating a return on their investment. Margin trading can be risky, as investors can lose more money than they initially invested if the stock price drops. However, it can also be extremely profitable if done correctly. 1. Venture capital. Venture capital is a way for wealthy individuals to invest in startups and early-stage companies. Venture capitalists typically use a combination of their own money and borrowed money to finance their investments, with the goal of generating a return on their investment when the company becomes successful. By using debt to finance their investments, venture capitalists can increase their investment capacity and generate even greater returns. However, investing in startups can be risky, as many startups fail to become successful. Investors should do their due diligence and invest in companies with strong potential for growth. 1. Distressed debt. Distressed debt investing is a way for wealthy individuals to invest in companies that are in financial distress. Essentially, the investor purchases the company's debt at a discounted price, with the goal of making a profit when the company becomes financially stable again. By using debt to purchase distressed debt, investors can generate significant returns on their investment. However, this type of investment is risky, as the company may not become financially stable again, resulting in a loss for the investor. 1. Mezzanine debt. Mezzanine debt is a hybrid form of debt that combines characteristics of both debt and equity. Essentially, mezzanine debt is a loan that can be converted into equity in the company if certain conditions are met. By using mezzanine debt, companies can access additional capital without diluting their ownership stake. For investors, mezzanine debt can be an attractive option, as they can earn interest on their investment and potentially earn a return on equity if the company becomes successful. 1. Structured finance. Structured finance is a way for wealthy individuals to invest in a portfolio of assets that have been combined and restructured into a new investment vehicle. Structured finance products can include mortgage-backed securities, collateralized debt obligations, and asset-backed securities. By using debt to finance their investments in structured finance products, investors can generate significant returns on their investment. However, these investments can be complex and risky, and investors should do their due diligence before investing. 1. Credit derivatives. Credit derivatives are a way for wealthy individuals to invest in the credit markets. Essentially, credit derivatives are financial contracts that allow investors to take a position on the creditworthiness of a borrower. By using credit derivatives, investors can generate returns based on the creditworthiness of borrowers, without having to invest directly in bonds or loans. However, these investments can be complex and risky, and investors should do their due diligence before investing. 1. Private placements. Private placements are a way for wealthy individuals to invest in companies that are not publicly traded. Essentially, private placements are investments in the equity or debt of a company that is not listed on a public stock exchange. By using debt to finance their investments in private placements, investors can generate significant returns on their investment. However, these investments can be risky, as the company may not become successful, resulting in a loss for the investor. 1. Securitization. Securitization is a way for companies to convert their assets into tradable securities. Essentially, the company bundles its assets into a pool and sells shares of the pool to investors. By using debt to finance their securitization transactions, companies can generate additional capital and potentially increase their profits. For investors, securitization can be an attractive option, as they can earn returns on their investment by purchasing shares of the pool. 1. Merchant cash advances. Merchant cash advances are a way for businesses to access capital quickly by selling a portion of their future sales to a financing company. Essentially, the business receives an upfront payment and agrees to pay back the financing company with a portion of their future sales. By using debt to finance their merchant cash advance transactions, financing companies can generate significant returns on their investment. However, these transactions can be expensive for the businesses, resulting in high interest rates and fees. 1. Asset-based lending. Asset-based lending is a way for businesses to access capital by using their assets, such as inventory or accounts receivable, as collateral for a loan. Essentially, the lender provides a loan based on the value of the assets. By using asset-based lending, businesses can access capital that they may not be able to obtain through traditional lending channels. For lenders, asset-based lending can be an attractive option, as they have collateral to secure the loan, which reduces their risk. However, asset-based lending can be risky, as the value of the collateral can fluctuate, and the lender may not be able to recover the full value of the loan if the borrower defaults. As with any investment, investors should do their due diligence and assess the risks before investing in asset-based lending. Overall, there are many different ways that wealthy individuals can use debt to generate returns on their investment. However, it is important to remember that debt can also be risky, and investors should carefully assess the risks and rewards of each investment opportunity before making a decision. Additionally, investors should have a diversified portfolio and not rely too heavily on any one type of investment. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Please note that this information is for educational purposes only and should not be construed as financial advice. It is important to do your own research and consult with a financial advisor before making any investment decisions. Until next time, happy investing!